For another highlight for the afternoon, I would like to present to you now Alan Clement. All those that are in the ATA know all about Alan Clement. All those that are not in the ATA, then you're missing out. Alan is a trading strategy designer and tester. He's also an independent trader. He has been for a number of years, 25 years, he says. We have to take him on his word for that. He's had a successful professional career in both investment management and in investment banking. He now manages his own independent trading business, and he specialises in design and development of quantitative trading systems. He is also a director of the Australian Technical Analysts Association, both in Victoria and nationally. He's also a certified financial technician. So please make Alan Clement welcome.
Thank you for that lovely introduction, which I wrote. Before I get started, just a word about the room heat. It's quite warm in here. We've had someone come up and turn the air on, so hopefully in the next 10 minutes or so you won't all be nodding off. Just a few thank yous as well. I personally think it's been a really good day so far, and it's taken a little bit of effort to get this up and running. So thanks to Paul Ash up the back who helped me out with the organising. Thanks to our speakers, of course, John, Daryl, and Grant, and to you all for coming along as well. So show appreciation. Thank you. Have you enjoyed it so far? Yes. Excellent. That's great. So well, that could all be about to change. So I'm here to have the last session on, I'm going to talk to you about the magic of dual momentum investing. And do I use the word magic lightly? Well, yes, of course I do. So is this the Holy Grail? Well, it depends what you mean by the Holy Grail. If you mean does consistent gains over most years with an acceptable amount of risk, then, I think certainly this gets towards that. So now you've got all the nuts and bolts about how to structure your self-managed super fund. As Daryl was saying earlier, an SMSF is not an investment in and of itself, so you have to decide what to buy, when to sell. So following on from John's talk this morning, this is another take, and you'll find some similarities in the styles of both John and myself, but this is certainly the approach that I like. So I won't labour the point on the disclaimer, but nothing's here as a recommendation to buy or sell. Please do your own homework. And I have got some strategy ideas in here, so please don't run off and trade it as is. Again, do your own research, do your own homework, and make sure it suits your style. I've not been trading for 25 years. I've been in the financial industry for 25 years. So my background was a software developer. I worked in investment banking and investment management. Left the corporate world about 16, 17 years ago, and decided to have a crack at trading. And since then, I've been lucky enough to sustain it as my only business. And I think I really sort of began to get consistent in the business when I discovered the quantitative approach. So in other words, having a fixed set of rules, a strategy, a systematic approach that tells you what to buy and sell, not you trying to decide by looking at the charts and what have you. And that, it takes some, not all, but it takes some of the emotion out of the decision-making process, and it allows you to track your results as well. So I won't be talking too much today about that side of it, but I will be focusing on the ideas I will be discussing will be systematic in and of themselves. I've tried every form of trading. I've tried trading every instrument from FX to options to futures to stocks to ETFs, and I've tried all time frames from tick charts all the way up to monthly charts. And for me, I've found what works for me. So, once you do find that niche, you just stick to it and keep mining it. So here's the sort of main parts of the talk I'll be covering today. I want to have a quick discussion about how markets work, and you may think that's abundantly obvious, but until you actually understand the how behind it, then that will then give us the why that we pick a particular approach. We'll have a talk about what momentum is, and then we'll move on to dual momentum, which is something slightly different. And then at the end, we'll bring it all together, and I'll actually show you some results for this as well. So how are we able to profit from the markets? You know, how is it that we are able to see an opportunity, get set in the market, and allow time to pass until a profit's on the table and we can get back out again? So imagine if I got a container, shipping container load of cornflakes at a very cheap price, and I set up a shop right next to Coles selling cornflakes $1 less than Coles are selling. What do you think would happen? What do you think Coles would do to the price of their cornflakes? They would immediately make it equal or less than what I was selling for. And how quick would that happen? That would happen within minutes or certainly within the hour. And I would be basically out of business. So in other words, it's very difficult to make a market in something like cornflakes or any retail product for that matter, because that industry or that market is very what's called efficient. People agree on the price of what cornflakes should be or what they want to pay for cornflakes, and they're not willing to pay a different price or a higher price. So in the financial markets, it works slightly different, of course. We can get onto, this is Qantas, I can't remember, it might have been last year or the year before, but we could have bought Qantas here for $4, and then within a month we could have sold it for a 25% profit, okay? So how can that be that, you know, the value of Qantas is down here, and then a month later, everybody suddenly agrees that it's actually worth 25% more. So all the planes and all the Qantas infrastructure and all the fuel in the planes and the route licenses and all that didn't go up by 25%. So there's something else at play here. And what seems to be at play is that there's no agreement in the market about what the price of any particular asset is, unlike cornflakes, for example. So that allows these trends to develop where, you know, somebody thinks it's worth this price and then the next person comes along and thinks it's worth a little bit more, and so he's willing to pay more, and so you get these trending moves developing. And so, in other words, if retail is a very efficient market, this is a very inefficient market, okay? And that's basically how we profit from the markets, because the markets are not efficient. They are inefficient in that it will allow time to pass for us to be able to get in, generate a profit, and get back out again. If the markets were very efficient, it would be $4 here, and within a second or two, it would be worth $5, if that's the way that the price moved. But it doesn't, so that's to our advantage. But what's interesting is that the markets are inefficient in some quite distinct ways. So we have things like momentum, which you'll probably be familiar with as, you know, trends developing and persisting. So once a trend is in motion, it's likely to continue in the same direction until it doesn't. Mean reversion is that sawtooth action that you see in the price, where price will be sold down, buyers will appear and push it back up, and price sort of moves in those waves. So that's the mean reverting inefficiency. And then you've got some others you can take advantage, like seasonality, where you've got the sell in May and go away effect, or the Santa Claus rally that you probably have all heard of. And of course, good old volatility, we know all about that at the moment, but you see volatility expands and contracts in the market, expands and contracts in the market. And so these are all ways that we can identify opportunities in these particular inefficiencies and make money. So we were talking about options earlier on. So, you know, volatility is a way to take advantage of that volatility. You can, you know, sell options when the volatility is high, and then you can cover your position when the volatility collapses again. Today, of course, we're going to focus on momentum. Momentum is more like a sort of what I would class as an investing strategy. You want to get set in a market, and you want to allow that market to trend in a particular direction, and then you'll take a profit somewhere down the track. It's also, well, we'll have a look at some of the advantages and disadvantages, but it's one of the methods that takes the least amount of time, you know, and unless you want to sit and stare at the screen all day, or you're there every day to make decisions, momentum is a very good way to go. So here's, here's which style should you choose. So, you know, you really want something that's going to match your lifestyle. If you've got time to look at the markets all the time, like somebody like me, then you can trade lots of different styles, or you can trade specific styles that need decisions to be made on the day. If you can only look at the markets once a week or once a month, then you need a bit of a longer term strategy. Obviously, you want something that suits your risk profile. So these these types of strategies all have different risk profiles. So some people are quite comfortable carrying, 30% risk in their portfolio. Some others are they'd be getting a little bit uptight if it went past 10. So again, find something that suits your risk profile. Time commitment I've talked about. Also volatility of returns. If you want to chase big gains, you generally have to accept more risk. Whereas if you're happy with just 10% per annum, you're going to get generally a very low volatility of returns. And things like ease of execution, are you able to just set the order and let it get executed? Do you have to be there to click the button? So all of these are factors in how you decide what to do. So what is momentum? Well, of course, we all know that the market is driven by supply and demand. If supply comes into the market, and the demand's not there to take it up, generally that will make the price fall, and vice versa. If there's lots of demand and there's not enough availability of supply, the price will generally go up. But it's worth remembering that supply and demand are basically derivatives. There's something else behind supply and demand that's driving them, and it's good old sentiment. The two fears that we have in the market, fear of loss here on the left, and fear of missing out, otherwise known as greed on the right. And it's worth remembering that these are two fears, Just think of yourself, what's worse, the actual, the taking of a loss or the missing out on a massive profit that you could have had? That one generally feels worse, certainly to me anyway. So this is basically what's driving the market certainly in the short term, it's much more sentiment driven. Perhaps in the longer term, it's much more supply and demand driven. But this is basically what's driving supply and demand, because when people are fearful, they're going to push supply into the market and drive the price down. Where people are feeling greedy, they're going to pay a little bit more than the last person, and push the price up. And it's neatly summed up in this quote that I found from Benjamin Graham, who was an investor back in the last century. And he says, in the short term, the markets are a voting machine, but in the longer term, it is a weighing machine. And that kind of sums it up perfectly, those competing influences of sentiment and supply and demand. And of course, we only have to look at a stock chart. This is the S&P 500 to see these trends developing. And you can see how once the trend is in play, it persists, both to the upside and the downside, and you could look at that now in hindsight and say, well, that's a very easy chart to trade. I could have traded that, and why are we not holding this seminar in the Bahamas then? And this is a very nice trending market, of course. But how many people bought here? Not me. But that kind of neatly encapsulates the fact that once momentum is in play, that it will persist, and the higher the momentum, the more chance it is of continuing in the same direction. And so we can make a couple of deductions from this. Trends persist. Okay, so the trend is, once it's in motion, it's more likely to continue in the same direction. And the stronger the trend, in other words, the higher the value of the momentum, the more likely it's going to continue in the same direction. So these are two things that we can use to our advantage. And a good metaphor for that is that I like to use is the skateboard. If I kick a skateboard along the road, it's going to carry on in the same direction until either the friction in the wheels slow it down, or it runs into something and stops. And it's exactly the same with the markets. Once the trend is in play, if it's going up, that's going to get people excited. It's going to bring money in from the sidelines and push the market higher. When when the market turns and starts heading down, there's that rush to the exit, like a fire in a nightclub effect, where everybody's trying to get out at once, and the price falls. Interestingly, they talk about up the staircase and down the elevator, and that's really just down to human psychology as well, because you want to pay a little bit more, but you don't want to pay too much more than the guy before you. Whereas when you're trying to get out, you don't care what price you get out, so the price falls very, very, very quickly. So how do we measure momentum? Because that's where this is leading to. If we want to find opportunities in the market, we have to be able to find good opportunities with using momentum. So we want to find some indicator that gives smooth, stable outcomes. So we don't want an indicator that's too noisy, that it's up one day, down the next, up the next, because that'll just lead to turnover. We'll be buying and selling very frequently. We want something obviously that goes up when the price goes up, and we want something that stays up when the price continues up as well. So that's what remains elevated. And we also want something that's what's called normalized, and what that means is that you can use the same indicator across a basket of stocks and get a relative measure. So something percentage-based, for example, certainly not something price-based, because a dollar stock going to $2 is not the same as a $50 stock going to 51. So we want to try and capture that differential. How big is the move relative to the price of the stock? And there's many ways to do that. Rate of change, quite like rate of change. Rate of change is just the percentage change in price over a fixed period. Then we've got ADX, which is Wells Wilder's attempt to come up with an algorithm to measure momentum. You have to be a little bit careful with ADX because it favors upside and downside momentum equally. So if the stock's hammering down, the indicator will be going up. MACD you'll probably be familiar with. Oops. A MACD and RSI interesting because a lot of people think of them as oscillators, that they show overbought, oversold, or they go up and down with the price. But if you lengthen out the look-back period, they will turn much more into momentum indicators, especially the RSI. The S stands for strength, and when Wells Wilder came up with it, his idea was that it would be a way to measure market momentum. Most people use it very short term, but you can use it 100, 150-day look back and you'll get something different. There are others. Anybody else got a personal favorite? Moving average angle is another one that people talk about, where you measure the difference in price between a moving average and then divide it by the ATR of the stock, so that removes the volatility component. So there's many ways to skin this cat, and if you go down the interwebs rabbit hole, you'll find dozens and dozens of others. So I guess the point is it's worth experimenting with all of these, or as many of these as you can, until you find the one that gives the results that you're after and meets your objectives and suits your style the best. We're going to use smooth rate of change, or some people call it CIROC, which is basically the rate of change, so just a percentage change over a given period. So say I pick the 100-day look back, I take the close price today, the close price 100 days ago, and work out the percentage change. So if it's gone from $1 to $1.10, that's a 10% rate of change. But because the rate of change is based just on the close price, as we know, the closing price itself is quite a noisy indicator. It goes up and down day by day. So in order to remove some of that noise, we're going to put an exponential moving average over the top of the ROC, and that will give us a smooth rate of change. You will find this in most charting packages, built in off the shelf. But if not, you can just do this quick calculation to get it. So here's an example. This is Netflix in the States, and you can see here. So the lower pane here is the smooth rate of change. The black horizontal line is the zero line. So zero indicates no price change in the last. I think this is a 6-month or 125 day look back period. So. So when it's below the zero line, that's saying that the stock is basically down in the last 6 months. Once it moves above that zero line, that's telling us that the stock is now positive over the last 6 months. So the idea, of course, behind momentum is that once momentum is positive, as we've seen from those charts, it will tend to keep moving in that direction. So, if we wait for momentum to become positive, somewhere along here is our buy zone, if you like, and then you can see the indicator remaining elevated as the price continues to trend up, and you can see it shoots up there towards the end, and the momentum follows. And keep an eye on what happens towards the end here, because we'll come back to that, what happens when the momentum turns the other way. Telstra was mentioned earlier, so I'll just bag it as well. The momentum works in both directions, obviously. So here's Telstra, and this is where's that? October 2016 here. So you see it did have positive momentum. It was up in the last 6 months, and now it dropped below the zero line. And you can see, if we had taken a position in that sort of circled area there. It continued on the same direction, down the momentum well, and again, interestingly, the momentum turning up at the end. So we'll discuss that as well. Now, you could be sitting there thinking, well, come on, Alan, you've just shown us two picture-perfect examples. These could well be outliers. How do we know that this thing is real? And if you are, then you're thinking exactly the way you should be thinking. Don't take anybody's word for anything that they say, least of all me. You need to do your own testing and really do, do your own research, really. But let's see if I can convince you anyway. What I did is I went back and I looked at the rate of change of a basket of stocks, and in this case it's the NASDAQ 100, at a particular point in time in the past. I can't recall exactly when it was, but it doesn't really matter. And then what I did is I looked at the return of each of those stocks after 6 months. So this each one of these dots is the rate of change as it was at that point in the past along the horizontal axis, and then up the vertical axis is the profit that stock or loss made in the next following 6 months. So you could look at that and say, well, that's just looks completely random to me. There's no trend in there at all. And welcome to the financial markets. They are very, very noisy, and the signal to noise ratio is very small, which is why it's so difficult to profit. But we can use some statistical analysis like linear regression. And if we drive a linear regression line through it, you can see that there is actually a tendency, let's call it. So there is, in other words, because this line is sloping up, that tells us that there is a positive correlation between the rate of change and the future return. So in other words, the higher a stock's rate of change, the higher its likely return will be in the future, and conversely, the lower or negative even rate of change value, the lower the return or negative return that's likely to be. So this is basically an edge, and you don't get much better edge than this in the stock markets because, like I said, it's very, very difficult. The markets are very, very efficient. They're not totally efficient, which is why we can pick these things up, but they're very, very efficient. So something like this is still good enough to beat 95% of managed funds out there. Okay, so let's have a look at some benefits of momentum trading. We've mentioned a couple already. They can produce big winning trades. You can get 3, 4, 5 times returns. Generally, between 2 and 3 to 1 is your profit factor. So it's nice having those big winners sitting on your books. Low turnover, so generally these things will turn over 20 to 30 trades. I think John used to do about 40, didn't you, a year, something along that line. So that's about right. One a week, one a week at most, or 2 or 3 a month, something like that. Long holding periods, so you're in these trades for months, 3 to 5 months generally, or maybe even a pinch longer. And they do well in these trending markets. So, just look at that S&P 500 chart, which has that sort of low volatility trending nature to it. If you can pick up stocks within that, they will generally do quite well. And because the index is an average, if you get the right stocks, you will generally outperform the index. Some drawbacks about momentum trading. Of course, you're carrying market risk because you're in the market for quite a long period, so your account's having to ride the ups and downs of the market. And of course, if you get an event like we've had in the last couple of months, you're going to get caught a little bit, and you need a good way to get out, which again we'll talk about in a little while. The other thing is, you can have long periods between equity highs. This is not generally a strategy that's creating a new high every week. When the market goes sideways or goes down a little bit, that's what your account will do. So, but if you can stick with it for the long term, you'll generally be rewarded by this type of strategy. And of course, as we know, they hate market volatility. So you have to have a way of either moving to the sidelines or having some other way of capitalizing on that volatility or hedging against it. So what the hell is dual momentum, if that's all about momentum? Well, dual momentum is basically, let's start over there. Ed Seykota. If you haven't seen Ed Seykota's Whipsaw Song video on YouTube, look it up. It is very good. In fact, I don't know if we might get time at the end, we might play it, but it's hilarious. It's all about trading and whipsaws basically. But he says the trend is your friend except at the end where it bends. And so that's really what the essence of dual momentum is. It's using two different attributes of momentum in order to capitalize on the good times and avoid the bad times. And those two attributes are the absolute value of the momentum and the relative value of momentum. So what do I mean by that? So absolute momentum is the raw number of the indicator. So if we're thinking about rate of change, if this stock's been up 10%, then that's your absolute value of momentum. Relative momentum is, well, how does that value compare to its peers? So if you're looking at a basket of 50 or 100 or 300 stocks, is 10 a high value or is 10 a low value? And so by using the relative value, you can decide which ones are the best. The best, of course, being the ones with the highest value of momentum, because as we've seen already, they're more likely to continue up in the long term. So absolute momentum is going to allow us to protect our risk, and relative momentum's going to allow us to capitalize on the big gains. And these things have been studied, for many years, and there's plenty of academic papers that look back in time and discover that this thing is real and that it persists. And it's basically, one of the few things that Goldman Sachs can't take from us, So this is a real edge that will continue to persist. And if you think that, we know the stock market has an upward bias, and the reason for that is because it casts off, losing stocks, and it ingests good stocks. So there's that survivorship bias, if you like, that causes the markets to always go up. The stock market, that is, to always go up in the long term. So returning to our two poster boys here, Telstra, of course, and so here we can see the absolute value of momentum. So say we said, okay, we're not interested in shorting a stock that's above zero. So we wouldn't be interested in Telstra while it's above that zero, and we would only be interested in shorting it while it has a low relative value relative to some other dogs in the basket. So maybe we don't pick it up here because it's not trending low enough, and then maybe we end up picking it somewhere in here. So that's the type of thing. And of course, when it crosses back above that zero line, well, that's our exit if we're not already out of it. Because don't forget, let's do the long side, which might make a little bit more sense. If we think of Netflix, when it crosses up through here, it may not. Say we were interested in looking at maybe the top 10 of the NASDAQ. Well, it may be positive here, but it may not be in the top 10 yet, and it's not until it comes up to this point that it suddenly appears in the top 10, and suddenly we get interested in it. And then again, as it rolls down this side, it will be dropping through our rankings, and eventually we might want to sell it. If we don't, when it crosses back that zero line, we'll get out. And just to labor the skateboard metaphor a little bit more, if we have two skateboards and if I kick one along the ground, but then I kick the other one a little bit harder, then obviously the one that I kicked harder is going to go further and faster than the one that didn't get such a big push. And so that's really what we're talking about when we're talking about relative momentum. We're talking about jumping on the skateboard that's going faster because it's going to go further, in probability terms. Not every single stock's going to do that. But there's a tendency, as we've seen, that linear regression line moving to the upside. So so starting to sort of think about how we can bring this together in some sort of strategy. Here's a couple of stocks here. Just say, for example, we only had enough money for one stock, and this is our basket. So we got to choose between these two stocks. So we're going to set our absolute minimum. So we're not interested in any stock that's not already up by 20%. And then we're gonna choose between these two. Now, of course, you could look at the chart and you could say, okay, well, this one clearly looks better. It's in a cleaner trend. It looks like it's trending up a little bit faster. But if we reveal the rate of change, you can see that this one, they're both well above 20. This one's up 97, and over whatever look-back period this is, and this one's up 105. So if we only could put our money against one, then the choice would be for this one because it has a higher value of momentum. And you could probably see why. This is a much lower price stock. So again, that's another reason you'll tend to find the better opportunities at the lower priced end of the market because, a $5 stock can go to $10, but a lot harder for a $100 stock to go to $200. Question? No, it stays the same value across all stocks. Yep. So when do we get out? So if we were just say we happen to be in that trade, that stock on the right, when we get out? Well, okay, before I get to when we get out, I'll just get my hobby horse out about stop losses, because I don't know if you use stop losses or not, but in the research that I've done, stop losses in strategies will tend to hurt the outcome. They will tend to reduce return and increase drawdown, which is kind of the opposite of what we want. And just to sort of illustrate how that happens, just imagine we got into this particular stock here where this horizontal green line is. We've got a trailing stop set. The stock's gone initially down, didn't clip the stop loss. It's gone all the way up here, and it's come back down, and then it's clipped our stop loss here. We've got out at the close of this bar. So, you know, it was a 2.3% loss. You know, losses happen. That's not a big deal. But what the big deal is that we were 6.5% ahead up here, and we've given that all back and more so our account value, its high water mark, was up here, and it's now introduced 8.2% drawdown to our account. So increased drawdown, reduced return, reduced potential return, opportunity cost you could call it, but 6.5% of profit we left on the table, and we ended up with a 2.3% loss. So stop losses are, because the price has to fall to hit it, they're generally suboptimal. So you might say, well, you know, who's going to tell us it's the top here? Well, I'll tell you who's going to tell us, and that's good old momentum. What momentum generally leads price. And so you can see with this stock here, I forget which one it is, but it's going up. And you can see the momentum topping out here where this blue arrow is. And the price does continue up for a little bit more, but you can see already the momentum's falling. So it's telling you that the pace of the increase in price is slowing. And you know, you can see the momentum fell way before the price actually collapsed. Oops. So what that means is that if we can come up with some strategy that can allow us to use momentum as our exit, we would be able to exit, see if I can get this thing working, you know, somewhere in this section here, you know, and anywhere in this section here is going to be better than down here where we might get our stop clipped. So, so we can use momentum both for the entry and the exit, and we don't need any stops in the system. And it might be, you know, you might not feel comfortable with that, but let me show you the results and you can make your mind up then. So let's bring it all together. So here's an approach. We're going to select a basket of stocks, and it could be anything. It doesn't have to be stocks. It could be a basket of ETFs or a basket of currencies or whatever your favorite instrument is. We'll choose an index of stocks. Could be the ASX 200, the All Ords, the Nasdaq, S&P 500. And then what we're going to do is we're going to look for an absolute minimum of the rate of change that we want to hold. So we don't want to hold any stocks below that level. And then we're only going to hold a small number. So we're going to buy a small portfolio of the highest ranking stocks ranked by their momentum. So we're going to be in the best stocks in the index, and then each week we're going to re-rank the index, and we're going to sell if any of them have dropped out of our top X, whatever it is, and then we're going to buy any ones that come out. So this is called a rotational strategy. Again, it's a little bit different to, say, buying a breakout and putting a stop loss under it. So it's a little bit different way of thinking, but it's as you'll see in a minute, it's actually produces a much lower volatility of returns, which is everybody's goal, I think. So we decide on a max number of holdings, and you know, generally you do some testing and you'll get the machine to tell you what that number is, or you might come up with it on your own. But generally you don't want too few, so you might say, well, I'll just hold the top one or the top three or something. That's all well and good. They will definitely be the best stocks in the market, but what you're doing is you're tying the volatility of your portfolio to a very small number of stocks. So if one of them has a very bad day and gaps down 30%, that's going to hurt your account much more than if you, say, held 10 stocks or 12 stocks where your risk is spread across the board. So if you hold 10 stocks, each one's only 10% of your account. And if one of them has a 30% drawdown, well, that's only a 3% impact. Other than a whatever it be, can't work out in my head. But so basically, a bigger number of holdings is better than a much smaller number, but you don't want it too big. So if I start holding 20 or 30 stocks, my returns are just going to start looking like the index. So there's a sweet spot in there. Usually it's somewhere between 10, 15, 16, so somewhere around that area. So if a stock is a new entrant up into that X number of top holdings, top rankings, then we buy it, and we just assign the position size to it. And if we sell it in either one of two circumstances, either it falls below that absolute minimum that we're gonna set, or it's no longer ranked in the top 10, let's call it. So once it drops out that top holdings, you sell it and you replace it with another one that's coming up. So that I've only got two hands here, but that crossover effect that you've got where you're selling a stock that's losing momentum and you're buying a stock that's gaining momentum will help to smooth out the gains as well. So you're not selling a stock when it hits, it's gone all the way down to its stop loss, and then you've got to hunt around for another opportunity to replace it. They're kind of that it's a cyclical thing that smooths out the gains as well. So here's an example, and this is not a finished strategy. This is really just an illustration. So again, there's some rules here, but don't run off and trade them unless you do your own due diligence first. And there's a couple of issues with the way that this is illustrated. So it has something called survivorship bias in it, which means all I've done is use the current constituents of the NASDAQ 100 and look back, and of course not all of them were in the NASDAQ 5, 10, 15 years ago. So that's a factor you need to take into account. There's an element of optimization in here as well. So just be a little bit careful. But again, it's an idea that you can perhaps take and feed into your own research and maybe do something with. So we're going to be long flat only. So we're not going to have a shorting element. We're just going to be long when there's opportunities around. When there's not, we'll just go to cash. We'll pick the NASDAQ 100 stocks. You can do this with any index. You can do it with the local indexes. I just thought I'd use the NASDAQ. It trends quite nicely, this market. But again, if you pick another index, you will have to test which parameter values are best for this. We're going to hold up to a dozen of the highest ranked stocks, so the top 12 out of 100. So we're only really looking at the very best, the top 8% of the market. And the NASDAQ, while it does trend very well, it does the stocks within it do have a level of volatility, so we have to be a little bit careful of that. I'm only going to expose our capital 66%. That's going to hold the drawdowns to between 20 and 25%, which I think is most people's limit. You don't want to be going over that unless you don't want to sleep at night. So that will give us a nice exposure. In other words, we'll just hold the last 34% in bank or term deposits or some other non-risk asset. So what we're going to use is what's called a fixed fractional position sizing. So that means we take the amount of capital that we've got, in this case 66%, we divide it by 12, and each stock we buy gets an equal portion of that cash, which turns out to be 5%. 5.5%. So you can see that you've not got very much stock-specific risk here. If God forbid one of these things goes to zero, which is highly unlikely, all you've lost is 5.5%, which is recoverable for most people. And here's what it looks like when you run it through the back tester. So it has a compound annual return of 23% on average. So that's this blue line here. You can see the returns are fairly consistent, but a little bit up and down above that number or below it. And obviously you've got 2008 here, which was a 22% draw, but within the next couple of years you'd recovered that. So again, it's not a finished system. I just really knocked it up so that I could have something to show you here. You'd want to spend a bit more time getting it to a point where you might want to trade it. But the max drawdown there, 23%. So generally what you will find with all trend following systems, in fact, is that the amount of annual return that you can achieve on a compounded basis is usually more or less equal to how much risk you're having to carry in your portfolio. So in other words, it would be difficult to have a max drawdown of 23% and achieve a 40% return per annum. That's just not going to happen. Of course, if we pumped 100% of the capital into this, you would end up with like 30% return and a 30% risk. So again, it just depends on your own risk appetite. The win rate's 56%, which is very good for a trend following system. Generally, trend following systems, you're talking 40s, low 50s at best. So 56% is very good. Again, the caveat that this has been optimized. We've got only 20 trades per annum, so very low turnover. One trade every couple of weeks at most, and an expectancy of 25%. So on average, you can expect each trade to return 25%. Of course, some will be more, some will be less. You'll have losing trades as well, but if you add them all together and divide by the number you got, you'll end up with 25%, which is not too bad. Turn 10 grand into what, 1250, something like that. And our average hold period is about 27 weeks. Okay, so again, that indicates the very low turnover in the system. And despite that long holding period, the market, and I mean that's the long holding periods, of course, what's causing this largest drawdown, because you're having to carry that market risk. But if you look at the equity, sorry, I should have explained to you, the green and orange line here, our green and orange area is the equity, and the black line is the index, the Nasdaq 100, the benchmark. So you can see it, it beats the benchmark hands down. But even the volatility of returns, of course, we're seeing these on a macro time scale, but they don't look too bad at that time scale. Obviously, I'm willing to bet the maximum drawdown was right here in 2008. So barring bear markets, your drawdown is probably going to be less than that. Here's an example of a trade. So this was EA. And back, so you can see it got in, that's up the top there, where are we? Here we go. So it got into the market September 2014, and it was in for, this was our longest trade. It was actually in for, 12, 14, 15 months. Here's the momentum crossing up through the zero line. It obviously got onto it quite early here. So for whatever reason, the rest of the peers at the time in the basket obviously all had a relatively low momentum value at that point. So this one was picked up, and as you can see, it was ridden up there. And here is interesting because actually it only got out because the momentum fell below our absolute minimum value. But otherwise, it actually got out of a very good spot. You see that? It actually just before it started to crack. And again, you can see that effect here with the momentum leading price. So as the price turns more sideways through this area here, the momentum all starting to fall. So you can imagine that as the stock, and stocks don't tend to go straight up and straight down. They do tend to go through this sideways pattern, and whether it's a head and shoulders or a double top or however you classify it. But that sideways, if you think about what's happening there, the momentum is tending towards zero. The return if it went sideways for long enough, the return would go right down to zero because that's there's been no up or down movement. So that's what's making that fall, and that's doing that's that distribution phase, if you want to call it that, before the rush to the exits happens. So getting out well before the masses, as it were. And this, if there is any magic in this system, this is it, I think. And so what we've got here on the equity up the top there and the index, and down here we've got a chart of the holdings, the number of holdings over the back test. So 12 was the maximum we were going to hold, and you can see there obviously there are periods where it was fully invested, but here, as the market turns more volatile through 2008, through these corrective phases in 2011, 2012, and again here in end of 2015, 2016, the system is automatically selling down the assets because they're falling, their momentum is falling below that absolute momentum level. So you're getting this effect where your risk is being automatically, if you like, reduced as the market turns more volatile until you've got no holdings at all. So there's no market filter in here. There's nothing that says, the index is falling, I'm going to get out. This is purely the logic of the system saying I have to be above a certain level to be in that stock, and if I'm not, and there's no other opportunities, I'm just going to move to cash. So you get this ramping down effect, if you like. And then by contrast, when the market starts improving, all the stocks start moving up, the momentum runs through the absolute limit, and you get this slow, gradual rise until you're once more fully invested. So it's taking opportunities without you even having to think about, should I be in the market, shouldn't I be in the market? This is actually doing it for you. And you can see, I mean, again, this is on a long time scale, but you can see how gradual sometimes that happens. So you're actually, and what I've found by trading this style over many years is that the system can often be ahead of the market. So it starts selling down, you think, hold on, the market's going up, why is it selling down? But that's obviously because in the pack, the stocks, there's leading stocks that are now falling. And don't forget, most indexes are market weighted. So when the index has gone up, that just means the top, 5 or 6 stocks by market cap are going up. So it's a really nice way of getting you into the market, getting you out of the market without too much thought, basically. Here's what the ranking. So this was a period back at the 1st of December 2017 when the system, well, let's call it a system. This particular piece of strategy code was fully invested. So you can see here, all the grey ones there are all the slots that are filled. And we've this particular week it's sold this one because it's gone from 12 to rank 14. So you can see its numbers lower now. And it's bought this other one, CDNS, because it's gone from 13 to 12. So it's moved up. So that's the rotational effect. And then you can see these other ones here where it says no position. All of these have an absolute value above 40. Remember, that was our minimum on the smooth rate of change. And then below that level, 39 and down, well, they're all excluded. So they're not even considered as being part of the rotation or available for rotation, not candidates. And fast forward to, this was Thursday night, actually, this week. So you can see what a dramatic difference it is given that the current state of the markets. And you can see what's happened. That's, in fact, if I go back to this chart here, you can see that currently the strategy's only got 3 positions open because the market volatility has caused all the stocks to fall, and it's slowly got out of them all until it's only got 3 left. I must have ran that at a slightly different time to this one because it's got, it's got 4 on board, but it wants to get rid of these 2, so these are the next 2 to go, which means it's going to, oh, no, that's right, yeah, there's the top 3, yeah, sorry. So it has still got 3, and you can see, you can have a look at the names. They're probably the 3, certainly the top 2 are the ones that you would expect to be there. So another benefit of this style is that it can still give you some exposure, some limited exposure, even when we're in a very volatile period of market condition. So those ones at the top, they're, if you like, they're still trending against the overall market. So it gives us the opportunity to still have some exposure, and we're not having to go completely to cash, but while we can still find some stocks that are going up. So just to summarize that, we've got, so momentum is sometimes called the premier market anomaly or the premier market inefficiency. It's the thing that just keeps on giving, you look at any chart, you look at the Dow going back 100 years, it goes up. Most stocks, and we have to say that it generally applies to the stock market more than anything else. Although you see trends in FX certainly, and even commodities, although those are a little bit more volatile. But generally, momentum, if you can find the best momentum, that's where you should be. Dual momentum, as we've talked about, is the combination of using both the relative value, so where is it compared to its peers, and the absolute value, so is it high enough for me to hold? And as we've seen, applying relative momentum will keep you in the best stocks, the strongest stocks, if you like. And then applying that absolute value will keep you out of those volatile markets because it will gradually take you to cash, as we've seen. And if you do, I'll take some questions now, but if you're interested in the stuff I do, which is quant developing and NAMI broker and so on, jump on the website. I've also got some cards up here which you're welcome to. But thank you very much for your attention. Questions?
Do you provide a newsletter too, do you?
No, I do a quarterly market update video. So if you go and put your email address on the site, I just no charge. I just produce it for myself more than anybody, just to figure out where we are in the market. So December's one will probably be interesting. Yeah. Yes, Daryl.
With the MACD, looking at the histogram and divergence between that histogram, leaving aside over or the rest of our stuff, but it looked very similar to what you were looking at there. But I know this is a rotational system rather than just looking at divergence. But have you ever built something based on the divergence between the price and the direction of the MACD?
So the question is about using the MACD, and I think if I'm hearing you right, you're asking about divergence. So whether when the I guess when the strength of the momentum starts to fall, is that what you mean? Yes. Yeah. Yeah, that's right. Yeah, so like some of those charts I showed, yeah, towards the end, I have, and the answer that I've discovered anyway is that all it does is leads to more turnover in the portfolio. It doesn't actually help. So you saw even that the momentum lines there, they would wiggle up and down themselves. So if you're selling as it's going down and then suddenly it starts going up again, you got to buy back. So you end up turning over your assets. And so your turnover goes up from 20 to whatever it happens to be. And generally you will your gains won't be as good because you're perhaps locking in losses and then having to get back in at a higher level, or locking in a price and having to get back in at a higher level. So yeah, good question. Thank you. Yes, sir.
How sensitive is the system to variations in the rate of change? Look back here.
Yep. So how sensitive is the system to the rate of change parameters, I guess? It depends what sort of look-back period you use. So I think the examples that I was using there was about a 6-month look-back. So if you anywhere between let's say 5 and 9 months, you'll get reasonably similar results. If you go too close, so look back period of say 10 days or 20 days, you will end up in some of that variation that I've just been talking about, where it goes up 1 minute, down the next. So you're buying and then you're selling, you're buying, you're selling, and then if you go out too long, so like past about 9 months, there's too much lag in the indicator, so you don't actually see the opportunity until the stock's already had a massive move. So you're getting onto it too late in the trend. So there is definitely a sweet spot, but it shouldn't make too much difference whether you use 125-day or 130-day or 135-day. They will all give you similar answers. Yeah. Actually, just on that topic, the smooth rate of change obviously has 2 inputs. It's got the look back for the rate of change, and it's also got the look back for the smoothing indicator, so the EMA on top of it. And again, that's something worth playing about with, because that will increase and decrease the lag depending on how smooth you want to make it. So I think about 20 or something, yeah. So with those ones, with all of these things, actually, the key is finding the balance between what I would call reactivity and stability. If you get something that reacts very quickly to the price, generally it's going to be it's going to be less stable. You'll get too many false positives, and vice versa. If you think of a moving average in price, you pull the moving average miles away from the price, you're only going to get a few crosses, but they're going to be very late. So in the middle there is that sweet spot. Yeah.
So what about the 40 cutoff on the upside?
Yeah. Well, I just ran it through the optimizer to find the number, but you would want to do it a little bit more rigorously than that. Very much so, yeah. So good luck trying to find a minimum of 40 on our market. You'd be in 1 stock or 2 stocks, yeah. So yeah, definitely it's very market sensitive, but again, it shouldn't. It shouldn't be, well, with all parameter inputs, let's say, it shouldn't make a difference where you go a little bit this way or a little bit that way. You want to find a parameter value that gives a similar results across a good range of parameters, all within the same area. Yeah. Okay. All right. Well, thank you very much. We're gonna do a quick panel Q&A. So it's up to you guys how long this goes for. If we run out of questions, we'll pack up early. But we'll just take a quick 2 or 3 minute break while we reset, and I'll get all the speakers up here, and we'll have a panel Q&A to finish off. Thank you.
Oh, is he?
Might have to get you up.
You could be Grant.
You're the closest acquaintance we've got to Grant.
Oh my God. Is he gone? Yeah, he had to go apparently.
That's all right.
Do you want to put up that
Oh, yes,
last slide?
yes, good
It's only
idea.
to advertise for the AGA.
Mm-hmm. Yep, definitely. Complete. Do you want to chair or are you all right?
No,
Yeah.
I'm probably better
Yeah.
to stand, otherwise I'll fall asleep. Yep.
Oh, well, yeah.
You want to bring it?